To continue with chart 3.9, this chart doesn't have moving averages on it, but you'd also want to be looking at your moving averages on RSI for what we had talked about, confirmation and enhancement of the positives and the negatives. But since a weekly chart is more of an intermediate to long-term perspective, I had mentioned whether you're trading, even if you're trading daily, you want to keep a perspective on weekly. If you're trading hourly or less, keep a perspective on daily. And I stress that because of the fact of the moving averages. On a weekly chart, if the moving averages are positive, i.e. the simple 9 is above the 45 on both close and RSI, it's setting the trend for you. If you are seeing positive reversals, like we're seeing here, the trend is still up. You're seeing bearish divergence. The trend is still up on a weekly. If you look at point 7 and point 11, you have a longer term positive reversal showing. We had gone through the one right after point 9 where the market dropped to 58.25, and then a couple weeks later, it was 3 or 4 weeks later, was 58.38. That 58.38 served as support because even on that pullback to number 11, it never took it out. But your last point there at 7, 53.59, where it looked like it was going to be a top-bottom support with the 53.61, when I take the 53.59 at point 7 and drew it through point 11 at 58.83, put the line in so you can see the line dropped off, showing that the RSI was slightly lower. And that line E, if you square your triangle off, if you use the 53.59 and take your line horizontally, you'll see it served as a support line. If you square the bottom off with 53.59, 0.7, find that on your chart, on your bar chart, and also take the 58.83, which served as a positive, and connect those 2 points. This is a weekly chart now with an intermediate to longer term positive that gave you an idea of where a trend line should be established based on your positive reversal points. It should be a good indication of what the intermediate to major trend should be. So you're getting an indication on the intermediate to major trend based on a positive reversal, intermediate to longer term positive reversal that showed up on your daily charts. If you extend that line all the way through into January, you'll see into January of 91, it came back down. First part of January, touched the line, went back up, and when it broke it, had a hell of a break all the way down. You'll also see the divergences in there with 12.12, you made a momentum high. 12 was a momentum high, and look at 13 and 14. You got a couple more little positives saying you're still up. 15 showed as bearish divergence. 16 went a little bit higher than it did at 15, but it created a more intermediate type to longer term divergence, and it actually took out, I believe, the RSI value at 15. But then when you look at 17 and 20, 17 is 67.62, and 20 is 68.09, and you're at the 60 level where number 20 shows up, but you get a divergence line G, but look how that divergence is a little bit below the divergence of line F. Okay? Also look at points 18 and 19 where you were 64.92 and 64.88. You were starting to make lower RSIs, lower price. And you say, well, we're still holding top-bottom support from point 12, 64.55. We've still got support at point 14 and 13, which were a positive reversal. Remember we talked about drawing the horizontal lines. If you go to where 63 and 60, or points 13 and 14 are, and draw a horizontal support line, you'll see that it's broken in January. It's starting to break down, saying that divergence was almost, line G's divergence was somewhat hidden. This is where I talk about hidden signals. Did not show up as high on the chart. In fact, point 20 was right around the 60 level. But this time your moving averages on RSI had turned down. But you're at that 60 level, and the positives that you saw at 13 and 14, drawing your horizontal support line on your bar chart based on those points, was starting to close below them. If you thought for a moment that point 14 and point 18 could be a positive, could still be a positive, then take your triangle, square off to where point 14 is at 63.30, and also where you think this positive is at 64.92 or 64.88, and look at a trend line there connecting those lows. You're able to tighten up a trend line. I like looking first at the lows, but I also connect it through those closes, because the closes are the reference points on the RSI chart. But being able to draw trend lines for support and resistance on your bar charts based on your RSI points can be very, very helpful. When we had talked about the moving averages, if you look at the chart on the next page, 310, it has your moving averages with the same points marked for you, although I didn't put the prices on it, but I put the same reference points on the RSI chart. When I had said line G, the moving averages, it crossed over to the downside. I'd said if you thought 18 and 19 were positive, how come then the moving average was starting to roll over and turn down? You made lower lows, lower highs. You made a lower close at 19 than you did at 18. So using the moving averages, and even back to the lower left-hand side of the chart, way back at number 5, when he said, when I was talking about it pulling back to the 40 level, the 9 had crossed the 45. The moving average had turned positive on that pullback to the 40 level. We had referenced number 7 before. Look where it had pulled right back to the 9 period, which was rising. 9 period of moving average. Since I say using moving average analysis on RSI not only smooths volatility, but helps you identify support and resistance points. Let's take a look at 3-11. It's a Swiss franc weekly chart. I marked some divergence points on there. If you look at points 10 and 12, you'll see positive reversal points. Point 13 and point 15, positive reversal points, pull back to the 60 at point 15. A rally to a momentum high eventually at 80, at the 80 RSI level at point 17. 312 has your moving averages on it. So you can see the different points in relation to the moving average. Now there I put just the prices on there. So what I want you to do is go back and reference the two charts and make, take the numbers that are circled on 311, move them over to 12 when you get home. But you can see the same type of pattern where you have divergence line, looking at 311 one more time. You have a divergence that showed up with 17 and point 19. Another divergence that showed up with 17 and 0.20, but then 21 and 23 started to show that hidden signal type divergence. And then when it started down from 0.23, your moving averages on your next page, 312, were already down. 79.64 versus the 80.04 close. The moving averages were turning down, and the RSI had rallied back up into the 45-day moving average, or in this case, a 45-week moving average, which was declining. 313 is an enlargement, so you can see it a little more clearly. But again, this is a weekly chart. And when you start to see weekly charts that are creating divergence or positives, this is why I said you always go to one longer time frame, because that longer time frame will influence the intermediate and major trends, and you want to make sure you're trading in the direction of the intermediate and major trends. 314 a good example. Look at 0.2 93.33, which was a momentum high. The market then sold off and created a bullish divergence with points 3 and 5. And when the market starts to rally, it rallies back up to 93.39 at 0.8, which took out the close at 93.25. Sold off to number 9 at 93.33. Rallied in 93.48, close at 0.10. Now points 8 and 10 turned out to be higher in close than it was at 0.2, 93.33. But look where that close was at 0.2. It was all the way up at the 80 level. So it was a momentum peak. When it sold off, created that bullish divergence and rallied back up to points 8 and 10, you got a little bit higher than you were at 0.2. And then from 0.10, you drop into reference point 11, 93.30 close. Look at point 11 versus point 9 versus point 7. 11 and 7 are positive reversal patterns again. And point 2 and point 10 become a long-term bearish divergence with a positive reversal showing with point 7 and 11. Now, points 7 and 11 show you a positive reversal, which followed what? The bullish divergence of points 3 and 5. You had a bullish divergence followed by a positive. Remember I said if you get a positive, look at point 1. We're going all the way back to the start of it. 92.78 at point 1. 92.87 at point 3. That's another positive. Lower RSI, higher price. But that positive point there at point 3 versus point 1 evolves into a bullish divergence. When you see a positive, which should be support, become your X point, it evolves into a bullish divergence. If it starts up and you get another positive after it, you should be at an intermediate move. So you start from this positive that shows up at 11 and 7, confirming the bullish divergence with points 5 versus point 3. So your positive reversal with 7 and 11 points to a difference of 6 added to the highest close at that time, which was point 10, 93.48, saying you're going to 93.54. The positive that you had with points 1 and 3 on an intermediate basis, that difference of 9 points added to 93.33 says 93.52. So you've got two objectives, 93.52, 93.54. And the market goes all the way up to point 12, achieving and surpassing those positive targets to go to 93.72, sells off to 13 from point 12 to 13, back up, creates a divergence a little bit later at 93.75. Everybody says the market's double bottom, or excuse me, double top, that's it. Even if you extended connected points 2 and point 12, you would have seen you would have a longer term divergence. Looking at it, most people say it's a double top, the market's going to break, and you sell off from 93.75 down to point 16 at 93.37 to get into oversold at a level approximating what your high was at point 2. What was overbought is becoming oversold. Number 6.16 versus 0.5. Here's another one of these longer-term positive that also showed up as an overbought, oversold, long-term positive reversal. And I've already put the line in, PR line D, based on 0.5 and 0.16. That difference, 92.84 to 93.37, 53 points added to 93.75 gives you an objective well up over 94.20. And the market starts to move back up. You almost, if you come past 16, you start to see the market turning up. See how many times it touched along that trend line. And look at points 21 where it rallies to the 60 RSI level, meeting what should have been first line resistance because of points 13 and 14, which was your first bottom top point. You rally up near 60, you pull back, you almost had another 2 or 3 period positive with 22 and 23, and you start moving up this chart. Your next chart, 315, has got your moving averages on it. So you'd be able to look at both of them together. 316 is an enlargement of that one area coming off the bottom. $317 is a T-bond chart where most of the activity was below the 60 level along line B. You got a little bullish divergence down there at points 4 and 6. You rallied up, you couldn't get much above 60. The moving averages stayed down until you got into the June area, the area of 17 and 18. Now go to chart 318. Look at points 18 and 19. You do not get a bullish divergence. But look at points 19 and 20. You get a little bullish divergence, right? 92, 19. Here's an example where it was the same price. 19 and 20 create a little bullish divergence. 20 and 21 do not create any type of bullish divergence. But look at 21 and 23. 92.21 versus 92.19. You get a little bullish divergence. You come back to the 40 level. Look how your 9 is turned up through your 45. Remember we talked about hidden signals when we first started the pattern recognition section. Hidden signals show up at intermediate and major trend changes. This is Treasury bonds, September of 91. So this took place in June of 91. Bonds were trading at 92.5, say 93. So from June of 91 to November of 93, a little over a year and a half, they went from 93 to 120. $27,000 just staying on one side of a trade. It's $13,500 a year. This is why I made the statement, you don't have to trade every day. You don't have to trade every market. Find the good ones and nail it. Other examples through this section, 319 shows another example, line C, of a longer term positive which followed September of that year, the basis of that line A, little 2-period or 3-period bullish divergence, a rally from late September into early October, a pullback, moving averages crossed and went positive. I drew that trend line connecting the divergent low with the pullback low to show you that you can draw trend lines on RSI that'll help you stay in tune with the trend. You get the rally up near 60. You created a little bit of bearish divergence at the top. I didn't put the prices on because I'm just showing you how to use the moving averages and draw your trend lines. But when you get the pullback in January of 91, and you look at the low the RSI made, the momentum low it made in October versus the January low, the January low RSI is lower. Look at the price lows, and I connected the two closes, and then the trend started. It bounced around for a couple days, and then it turned up, and then the moving averages crossed, and it went all the way up to the 80 level. 320 I put the RSI on first with just the numbers, and 321 has your prices. And if it didn't come out as clear as I'd like it to be, number 3 there you might want to mark is 373.50 for the close at point 3, 372.25 for point 4. So you had 1, 2, 3, a little 4-period bullish divergence at the 40 level. But look at point 3 versus point 1. The price is 373.50. The price at point 1 is 372.20. Longer term positive at the 40 level that evolved into a bullish divergence. You get a rally from point 4 up to 5, a pullback into number 6 at 376, finding support just above the 9-day moving average or 9-period moving average. Another rally at almost a rally to 7, a pullback to 378.55, which is 0.8. Then the market moves higher. Moving averages start to cross and turn to the upside. Gets up to numbers 9 and 10. Pulls back on a sell-off to just below the 45, but the 9's still above the 45. And look at line at point 8, 378.55, and point 11, 380.75. A positive reversal. Intermediate, it's outside 2 to 5, but it followed after the bullish divergence. And the moving averages are positive just on our side. We didn't even have the moving averages on close on this chart. 322's got an enlargement of the area, but I want to show the broader picture first. But you look, circle point 8 and point 11. Circle points 3 and point 4. And circle point 1. So that you can see the intermediate positive, well outside the 2 to 5, but the fact that it's still got more oversold at a higher price and bounced back up, evolving into a 2 to 5 period signal, a rally, a crossover the moving averages, and then point 8 and point 11 turning into a positive. Good market technically, I think the S&P is, but I think the margin requirements are absolutely ridiculous. For the amount of money you have to spend on margin, I think your money is better spent in other places. But most of the charts in the rest of this section pertain to using the moving averages, spotting the patterns the one on 325 and 326. 325 and 326 is an example of an hourly. If you look at the close, look how you get a little divergence there at numbers 4 and 5 on page 325. 93.23 versus 93.23. Same price, but it showed as a divergence. When we talked about whether it's the same price or greater price, I like it more when it's a greater price, but the fact that it shows after a momentum high. You see the momentum high number 2 at point 2, 93.24. Then look at the two prices at points 4 and 5. It's a tick under that, showing that momentum high, that closing level had a lot of resistance. It ends up with 4 and 5 being, again, like a hidden signal. It doesn't stand, it stands out by itself, but it's still below the initial momentum high that was created at 2 that never really evolved into a bearish divergence. I pointed that out earlier. When you make a momentum high and don't create a bearish divergence, usually you get a sharp, quick sell-off. And you look at that price action, it did sell off rather quickly. This is an hourly chart. So 4 and 5 create a little bearish divergence. You sell off, moving averages cross. I put a little star there right after point 5 where the moving averages turned down. Now look at point 6 versus point 1. Point 6 along line B, 92.23, versus point 1 to the left-hand side of your page, 92.21, showing at 92.20 area should be support. It also shows point 1 versus point 6 is an intermediate type positive, correct? You get a bullish divergence with 6 and 7, you get a bullish divergence that followed a positive, saying that we should start to see it move up. You get another bullish divergence with points 7 and 9. We had gone through a daily chart that showed a lot of these same numbers on a daily chart, and here's the hourly showing the same thing. So 6 and 7 show a bull divergence, 7 and 9 show a bull divergence, and I drew the line line B, connecting 6 and 7. Looks like I drew a line there connecting 7 and 9 but didn't mark it, so you might want to mark that line B2 just for your future reference. And from point 9 it starts to rally up, and on a little pullback and a correction to point 10 came right back to the line, started to turn up again. I put a little star with an arrow pointing to cross over the moving averages, which are now turning positive. A rally up to the 60 level, little pullback, and a rally up to point 12, which gets to 93.27, takes out the divergence of points along line A at 93.23, saying we are now making new highs. And 12 and 13, I believe, are one of the points where you get a divergent, you get a momentum high that stays unchanged for a period or 2 or 3. A down and then an up to about the same level, so it's like a divergence, but the first, your X point is like 3 X's in a row. It's the same level, then a down and an up. So it gets a little overextended, creates a little bit of a divergence and sells off, and you get 14 and 15, 93.25, 93.26, a bearish divergence. Another one after that at 93.27, and after that 93.26. So it's starting to compress in there. So you say bearish divergence, we should see what? A little bit of a sell-off. Corrects back down. Where's the support? You start looking at the previous bottoms, which have been holding 92.20. Look at number 11. The first attempt out of the bottom, it rallied up to 93.05 at point 11. For the first run, pulled back and then went to new highs. You figure your 50% retracements
You started off from 92.19. You went as high as right after point. You went as high as 93.29 was your highest close at 0.13. So you went up 1 and 10/30 seconds. So you went up 42 points. You would expect to see it pull back approximately 50%. So half of 42 would be 21 points. Your low close was 93.19. 13 points would give you 93.00, and another 9 would give you approximately 93.09. You pull back to 93.08 at 0.16. Now look at 16 versus 10. The line D, it's a little bit lower. It's starting to create an oversold condition. It's at the higher prices. You're holding close to you just dip barely below the 40 level. And we start a rally from there that says, okay, we've got bearish divergence showing, looks like positive reversals, but the moving averages are down, but we should expect to see a bounce. You get the bounce up to 18 that looks like it may be a negative at 93.22 at 0.18 versus the points along line C there, 93.26, 27. A little bit of a sell-off to 19, back up. The market's going back and forth, chopping around. But when it comes back down again and tests the 40 level, you're finding that support again at 93.08, 93.09. The moving averages appear to be turning up a little bit more. So you'd want to draw your horizontal support line based on 16 across the chart. When you have all this bearish divergence that shows up at points 14 and 15, when you start to see bearish divergence come in, it should be a point to where you say, okay, bearish divergence means it's overextended, we should correct. Bearish divergence also means that if we find the same levels on our price chart, square your triangle off at the bottom to go up to those 93.27, 93.29 area with referencing points 13, 14, 15, draw a horizontal resistance level based on your divergences. Say if this is bearish divergence at 13, 14, 15, it should be resistance. The market should sell off. It accommodates you by selling off, but you now know that if it closes above that divergence and above the levels which the divergence was created, you should negate the divergence. You're seeing support at the 40. Not only will you negate the divergence, you'll confirm the uptrend, as we talked about before. When you negate divergence, you should see an acceleration to follow, which you do. $326 is an enlargement of that area, so you can study it a little more closely. That completes that section. The next section there, section 4, price targeting. I've shown you how to do the calculations and everything. I just put some more examples in, but I want to spend a minute, if I can, with identifying and discussing the difference between the positives that are naked and the positives which show as enhanced signals. So on page 4.2, we're talking about naked signals, which are positive reversals without the moving average confirmation. Going through these charts that we just did, you saw where the moving averages are very, very helpful for trend analysis, but they can also be used as support and resistance, especially the 9 period. On a shorter term basis, and the 45 period moving average on a longer term basis, both on closing price and also on RSI value. When you see the positive reversals show up and your moving averages, your 9 is above the 45 on close and 9 above 45 on RSI, start doing your homework, because that's going to be a stronger signal. If it's not, then it becomes one of what we call these naked signals. And that's why I set forth the moving average analysis guidelines of either both up. If both sets of moving averages are positive, the trend is up. If both sets are negative, the trend is down. If the moving averages on close are up, moving averages on RSI are down, the trend is still sideways up. The RSI moving average is much more sensitive than the closing price moving average, because the RSI is much more volatile than closing prices. The shorter term signals that develop, you can use when we would put forth the shorter term sets, simple moving average 4 with exponential 20. I had decided on those because they were half the length of the standard set that I like to use, the 9 and the 45. But you can use them as a lead indicator of what the 9 and the 45 are going to do. If I can just stress the point that you will be very happy, your bottom line will be much better if you know and recognize the difference between the naked and the enhanced signals, and concentrate on enhanced signals. Concentrate on the 2 to 5 period signals. We showed examples of long-term in the pattern recognition there. We showed examples of intermediate to long-term positive and negatives, but the ones that are most powerful are the 2 to 5 periods, when they're 2 to 5 periods apart. But you want to be aware of the longer-term positives and negatives, because that sets the bigger trend. When you spot longer-term positive and negatives, look at where your moving averages are, so that you know whether it's an enhanced signal or a naked signal. And I just want to go through a couple of the charts. We had covered some of them when we went through the moving average section. If you notice with 4-3, look at the low in the RSI in March. Look at the low and momentum low in the RSI in April on the bond chart there in 4-3. Double bottom in price, slightly higher bottom in RSI. In April, where the RSI had tried to rally up near the 60 level, created a little bearish divergence right at the 60 and turned down, but both moving averages were up at the time the divergence was created. So the moving average says if both moving averages were up in early April, where this little 2 to 5 period divergence established itself, the moving average analysis says it's up. The fact that it has bearish divergence says it's up. The pullback, when it does drop back off into April and looks like it's going to double bottom with price, you start to get an intermediate type divergence well outside 2 to 5. I mean, it's about 5 weeks apart. But when it turns up from there, the moving averages cross. The 9 crosses the 45 on RSI in the first part of May. The closing price moving average is crossed. The longer term moving average, the 45 period moving average, also crossed above 50. It had been below 50. It had been below the center of the chart, or the midpoint of the RSI values. And it crossed above the 50. And look how many times in late May and early June you were banging on that 45-day moving average of close. And if you go back and look at how many times the RSI sold off back near 50 and created little minor positives, I shouldn't say minor positives, there's nothing minor about a positive reversal, but positive reversals that showed up first trading day of June, and then a couple periods later, maybe 6-7 days later, another positive showed up touching the 50 line. Then the moving average of RSI turned back up again. If you look at the momentum peak in May, where the RSI got almost to 70, then look in the second half, the latter part of June, to where your close was an attempt above the 60 level, 2 attempts above it, that almost created like a little bearish divergence. In the RSI, which it then broke out of, negating it, and the moving average actually broke above that trend line. The moving averages on RSI and close were both positive. So if you see a bearish divergence show up and the moving averages are positive, it should probably break it to the upside. And once it breaks it, you have further confirmation that you are up. But I can't stress enough the fact that you will be very happy sitting with or analyzing your charts in a way in which you can use the moving averages to help you evaluate whether a trend is up or trend is down, and help confirm your positive and negative reversal signals or enhance them. Your next chart, 4-4, you'll see 2 little bearish divergences that showed up, one in May, one in June. That June was right at the 60 level, but look at the difference in the levels. The second divergence that showed up was somewhat below the first, and right after that divergence, as RSI dropped, moving averages of RSI turned down. If you think that that low in May in the RSI, in late May, and the first attempt at the 40 level by the RSI in June, if you think that's going to be a positive, a lot of people say, well, there's a positive there. Your moving averages were turning down, saying, don't jump on it. Be careful with it, because if you start to see positive reversal patterns, this is why I say the enhanced signal with the moving averages confirming is very, very helpful for helping to spot not only divergences, but helping to show you which positives should be strong and which may be failures. And in this case, the pullback in May and the first attempt in June where the RSI drops almost to 40 and then rallies back up, that looked like it might have been a little positive reversal, but your moving averages were starting to cross to the downside, saying it shouldn't be a real strong signal, but you might get a rally or a bounce out of it, which you do, but it rallies in late June back into a declining 45-day moving average on RSI. If you look at your bar chart at the top, the moving averages had crossed down, and even though the bar got above the 45, the 9 was below 45 on close, 9 below 45 on RSI. If you say, well, what about the positive point where in April, the RSI in April had dropped down to about the 30 level, and right after that bearish divergence we have in early May or in mid-May, we have a sharp sell-off. Well, what about that RSI dropping back? Moving averages are positive on both close and RSI. Draw a little trend line connecting the April low with the May low. If you connect the April low in RSI with the May low, you will see where the moving average it was set up to where it almost broke it right at that trend line. If you move it up the top of the chart to where, and square, as I said, square off that pullback support in May with your low in April and connect your closes there, you'll see where it come down and touched it in late May. And you said, well, we should get a bounce. It rallied above it, went back to the upside in late May. Early part of June, it sold off, almost touched it again, rallied back up again in price, created that second divergence. But look what happened to the price when it started down from that high in the first part of June, broke the trend line, then had trouble getting back above the trend line just as the moving averages were closing, crossing to the downside. So I think it'll be very, very helpful for you to use both, use your triangle, look at the crossover, see where the crossovers go, see the direction the moving averages are pointing, and see what type of signal you have, whether it's just a plain bearish divergence, where your moving averages are, or if it's a positive or negative and where your moving averages are. But I can't stress enough that trend analysis is the mainstay of most successful traders, and this will help you do it.